Hello and welcome, everyone. We are jumping right into this comprehensive explainer on Essay 1010, looking at agreeing to the terms of audit engagements. If you are prepping for your exams or just looking to brush up on your professional standards, you are absolutely in the right place. We're going to make this complex topic super clear, completely thorough, and very easy to remember. Here is our roadmap for today. 1. Scope and objective. 2. Preconditions for an audit. 3. Agreeing to engagement terms. 4. Recurring audits and changes. 5. Law and regulation conflicts. And finally, 6. Engagement letter examples. Section 1. Scope and objective.
Notice that crucial word highlighted right there, only. The standard is extremely strict about this. An auditor's primary objective is to accept or continue an audit engagement only when the basis of the work is fully agreed upon with management. You literally cannot start an audit on assumptions. An auditor has to establish a common understanding with management, so there is absolutely no confusion about responsibilities before the actual work even begins.
Section 2. Preconditions for an audit.
So, before an auditor can even think about saying yes to an engagement, certain mandatory preconditions simply must be there. What are they? Well, they rest on two main pillars. First, management has to use an acceptable financial reporting framework. Think of the accounting standards issued by the ICAI. Second, management must agree to the basic premise on which an audit is conducted. They have to know and accept their core responsibilities. Without these two things, an independent audit just cannot happen.
Let's look a bit closer at that second pillar. What exactly is this premise? It means obtaining management's explicit agreement that they are responsible for a few key things. They are responsible for the preparation of the financial statements and for maintaining internal controls to prevent material misstatements, whether from fraud or just a simple error. Plus, they must provide the auditor with total access. We're talking access to all relevant records, any extra info the auditor asks for, and unrestricted access to people within the entity to gather audit evidence.
Now here is a massive red flag you always need to watch out for. What if management tries to restrict your work from day one? Like, what if they say, hey, you can audit everything, but keep your hands off our bank statements? If management imposes a limitation prior to acceptance that you, as the auditor, believe will result in a disclaimer of opinion, you must strictly reject the engagement. No questions asked. You cannot accept a limited engagement like that unless a specific law or regulation legally forces you to.
Section 3. Agreeing to engagement terms.
Okay, assuming the preconditions are perfectly met and there are no shady scope limitations, we have to document everything. These agreed terms go straight into an audit engagement letter. This document needs to be neat, clean, and complete. It must lay out the objective and scope of the audit, the responsibilities of the auditor, the responsibilities of management, the exact financial reporting framework being used, and what the final auditor's report will look like. Also, especially in the Indian context, it's very important to mention that the audit process might be subject to a peer review under the Chartered Accountants Act.
But let's think about a common practical scenario. What if local law already dictates these exact terms? Well, for item 1, if the law prescribes responsibilities in sufficient detail, you don't need to write out a massive, repetitive letter. A simple written acknowledgement from management that the law applies and they understand their duties works just fine. But looking at item 2, if the local laws lack that specific detail, your engagement letter must explicitly list out all of management's responsibilities, strictly following SA 210.
Section 4. Recurring audits and changes.
So what happens when you audit the same company the next financial year? Do you need a brand new letter every single time? Actually, no, but you do have to check if circumstances demand a revision. You definitely need a new letter if the entity misunderstands the scope of the audit, or if there's been a recent change in senior management, or a significant change in ownership. You'd also revise it if the business size changed massively, or if there's a totally new legal or financial reporting framework in place.
Sometimes, right in the middle of an audit, management might suddenly ask to downgrade the engagement to convey lower assurance, like changing a full audit down to a simple review. So what is the protocol? Step 1, you get the request. Step 2, you carefully evaluate if there's a genuine, reasonable justification for this change. Step 3, if it's justified, great, agree and record the new terms. But step 4 is where it gets serious. If there is no good reason and management is just trying to block the original audit to hide something, the auditor must withdraw completely and figure out if there's a legal duty to report this to the regulators.
Section 5. Law and regulation conflicts.
Now we hit a really interesting challenge. What happens when local laws and our standards on auditing clash? First, we need to know how to judge a framework. Appendix 2 gives us 5 acceptable attributes for a general-purpose framework. It needs relevance to the users, completeness of all transactions, reliability that reflects true economic substance, neutrality, meaning it's totally free from bias, and understandability. If it checks these 5 boxes, it's generally acceptable.
But what if the law prescribes a framework that lacks those attributes and is actually unacceptable? SA 210 says you can only accept the engagement if management agrees to add extra disclosures so the financial statements aren't misleading. Plus, your auditor's report will need an emphasis of matter paragraph. And this is crucial. You absolutely must not use the specific phrases, present fairly in all material respects, or give a true and fair view in your opinion, unless the law specifically mandates those exact words.
Similarly, what if local law forces you to use a report layout that completely contradicts our auditing standards? If adding extra explanations still can't clear up the misunderstanding for whoever is reading the report, you cannot accept the engagement unless the law forces you to. And if you are forced to do it, you absolutely cannot state that your audit was conducted in accordance with standards on auditing. You just can't make that claim.
Section 6. Engagement Letter Examples.
Let's make this super practical. Appendix 1 of the standard gives us 3 detailed illustrations of engagement letters. This table breaks them down perfectly. Illustration 1 is your standard general-purpose framework with the usual SA requirements and that peer review clause. Illustration 2 is tailored for audits under the Companies Act 2013, where reporting on internal financial controls, or IFC, is applicable. And Illustration 3 is for companies where IFC reporting is not applicable, but it still packs in critical checks like director's disqualification and fraud reporting.
For our Indian companies out there, Illustrations 2 and 3 show that the letter has to cover some very serious ground. Management has to acknowledge responsibilities regarding reliance on branch auditors, the going concern basis, and the adequacy of internal financial controls. It also specifically lists checks for Section 164.2, Director's Disqualification, any delays in transferring funds to the Investor Education Fund, and the auditor's strict legal duty to report fraud straight to the central government under Section 143.12.
So, taking all of this in, here is a question for you. What if management simply refuses to give you a written agreement of these fundamental responsibilities? Could you just accept the engagement anyway, for the sake of public transparency? The answer is strictly no. Without their cooperation, the entire foundation of an independent audit falls apart. You simply cannot gather sufficient appropriate audit evidence if management isn't on board from the start.
And that thoroughly covers every single aspect of SA 210. Just remember, if we don't get the terms of engagement perfectly right at the very beginning, there is no way anyone can trust that final audit report at the end. The foundation has to be flawless. If you found this explainer helpful and it cleared things up for you, please like the video, share it with your friends and colleagues, and subscribe to our channel for more complete CA Standards explainers. Thanks so much for joining us, and I'll catch you in the next one.